Hey everybody, welcome back. So today I'm going to be talking about call options, what they are, and just some basic advice for this is really for beginners because I know that a lot of you may be a lot more advanced with options. So this is definitely a beginner video for options, and I'm going to be discussing call options specifically. And so, yeah. Okay, so first I'm going to talk about how a call option works, what it is, and then I'm going to show you a couple indicators that really will be helpful for you to take a look at before you buy a call option. And then I'm going to end this video with a couple tips, general advice on how to trade call options. Okay, so just right off the bat, I just want to be real transparent with you and tell you that a call option is basically a bet. Okay, you're betting that the stock will go up by a certain time. And if it goes up, you're going to profit. If it goes down, then you're going to lose money. And the reason why it's different from investing is because if you're wrong on, whether the stock goes up, then you're going to lose all your money, okay, that you put in. Now, whereas if you're invested into a stock, okay, you're buying shares, and even if it goes down, you can wait it out, and if the stock eventually goes up, even if it takes 1 or 2 or 3 years, then you're gonna make a profit. Okay, so call options are definitely more risky. Okay, they're if you're new to it, I would definitely recommend spending more time reading into it, even practicing with it before you trade call options. Okay, so the most basic option really is just the call option, and the way it works is you would go into your brokerage. I like to use Robinhood, like really just because how easy it is to use it. They have a really clean interface. It's just really easy to use for beginners. And so even if I have other brokerages, which I do, I still use Robinhood just to help me visualize and see what the trade looks like. Okay, so the first thing whenever you're buying a call option is you want to set your expiration date. Okay, so the expiration date is just when the contract expires, and generally speaking, the shorter time that you have, the more the more the option contract will decay. Okay, so what decay means, it just means that it loses its value over time. Okay, so let's say you open a contract, a week from today, it's gonna really quickly decay because you have less time for your option to profit. Okay, so I just want to give some advice off the bat. If you're starting new, you definitely don't want to open up call options that is too close to the current date. Okay, so you want to generally open up longer call options, even though they're more expensive. It gives you more time for the stock to come into fruition. Okay, so I even talked about something called a leap option, where you buy a call option that expires at least a year or more out. Okay, so I'm using this example, American Airlines, and I'm going to show you what buying a call option looks like. Okay, so whenever you open up a call option, you can buy either above the share price or below the share price. Okay, so above just means, above the share price is what people call out of the money, and below the share price is what people call in the money. Okay, so if you buy a call option above the share price, the stock would have to move up, okay, by the expiration date for you to profit. If the stock moves down, or sorry, if you buy below the share price, the stock has to move up, but it has to move up a lot less. Okay, but the premium you pay will be more than the premium you would have paid for an out of the money call. Okay, so let's take American Airlines for example. Okay, so let's say we set expiration date of American Airlines for April 14th, 2022, buying call option. So on April 14th or before then, you'll have basically the right to buy the stock at whatever strike price that you set at. Okay, so the strike price is basically the price that you set at that you want to be able to buy the stock at. Okay, so for example, if I bought a call option at $15, I would have the right to buy American Airlines at $15 on April 14th or before then. Okay, so the stock goes up, then I make money. If the stock goes down, then I lose money. Okay, so in order to have this option, I would have to pay $3.13 per share and every option is basically 100 shares. Okay, so you would multiply this by 100, and this would be $313. Okay, so that's basically how call options work. And in this video, I also want to talk about selling call options. Okay, so let's say that you have 100 shares or you have bought a call option. Okay, so basically, if you have a call option on, for example, American Airlines, you can also sell a call option. Sell a call option is really just the opposite. Okay, so meaning that if the stock goes up to a certain point, and if it hits your strike price, then you're going to be forced to sell that stock. Okay, so let's say you bought a call option for American Airlines at $15, but you also sold a call option at $19. So if the stock goes up to $19, then you're going to be forced to sell your stock at $19. Okay, what's great about that is you collect the premium, so you collect money for doing that, for selling that contract of $125. But if the stock, let's say the stock jumps up to $20, you lose out on that $1 that you would have gained had you simply just had shares of the stock. Okay, but at the same time, you keep the premium, and you also, of course, gain whatever the stock went up by that reaches to $19. So if you had bought the call option at $15 and you sold a call option at $19, then you would profit. Your profit would be in between, minus whatever you paid for the call option that you bought. Okay. Now I know that's a lot for just call options, and I know it can be confusing, but just know that basically you're buying an option to buy a stock at a later date, and basically the stock has to go up for you to profit. If the stock goes down, you may lose your money. Okay, and these days, honestly, some of my tips is a lot of people buy call options with a pretty short expiration date, and they're betting on the stock going up. These days it's just really hard to know when the stock is gonna go up. Even if the company is solid, even if you look at the fundamentals, and you're just positive that this stock is gonna eventually go up, we really don't know when, and that's why buying short-term call options is the reason why a lot of beginners lose a lot of money. Okay, so if you were to buy a call option, I would definitely buy it for longer. Yes, you're going to pay more premium, but you would have definitely more time for your whatever analysis you have to come into fruition. Now, a couple of things I want to talk about real quick that would help you with whatever you decide to buy call options on is, first, I would always take a look at Yahoo Finance, and I would take a look at something called a Bollinger Band. Okay, so you go into Yahoo Finance, type in your stock ticker, you go into chart, okay, and then over here you'll see the moving average. Okay, so if the moving average is below, if the line is below the moving average right here, Bollinger Band is just basically a research that came out a long time ago. It just shows you the moving average, and generally speaking, the stock will kind of move towards the average. So if it's below the moving average, then there's a pretty good chance that it will go up to meet the moving average. Okay, so right now, because it's trading below the moving average, I think it's a great time to buy. Okay, so the other one I would take a look at is Finviz. Okay, so Finviz tells you a lot of things that are really important before you buy call options. And the first thing is really just RSI. RSI is a relative strength index. It tells you if it's overbought or oversold. So it just basically means that if more people are buying or more people are selling, generally speaking, if it's the RSI is below 50, that means it's oversold. Okay, if it's above 50, it's overbought. Okay, so generally if it's under 50, you'll know that more people are selling than buying, and it may be a good opportunity to buy because more people are selling. Okay, and this is aside from all the financial technicals. And whenever you take a look at a company, you always want to take a look real quick into their finances, see how they're doing with cash flow, revenue, their EBITDA, which basically tells you their profit. American Airlines is not profiting, but understandably because of the whole coronavirus and Omicron. But these are just all different analyses that would help you in buying call option. If I were to just summarize call options in a few words, it is a bet. You don't want to buy call options that's too short term, because you're really limiting yourself to whatever catalyst that can only happen within a certain time. And other than that, guys, honestly, if you're just starting out, I would really just start out by probably buying shares. If you really want to do options, maybe you can do like a couple percentage, like 5-10% of your portfolio. But I really wouldn't do too much when you first start out. I hope that's helpful for you guys. If you like this kind of content, if you want me to make more videos like this, make sure you smash that like button, subscribe, comment below if you have any questions. I'm always more than happy to help. Until next time, guys, I will see you in the next video.